Hello everyone, welcome to Smart Investing. What is the fair value of NVDA today? Should you buy it, should you hold it, or should you sell it? And what is the expected value of NVDA in 5 years' time? So if you want to know these answers, please stay tuned until the end of this video. I'm going to show you a pro-like fundamental analysis on NVDA. I've developed one of the best prompts on AI, and I'm going to show you exactly what it delivers. So if you want the same prompt for you, and you can apply it for any stocks that you have in the stock market, and you want to know its fair value and its fair value in 5 years, then drop me a message. I'm going to send it to you for free. So let's get into it. So first of all, I'm using for this analysis the official report of NVIDIA. You can see, I show it to you here. You have all the data. NVIDIA announces financial results second quarter of fiscal 2026. Income statement, balance sheet, cash flow statement, reconciliation gap to non-gap, which is a bit less important for us, and you have all the outlooks for NVDA. Also, that you have here a section for outlooks. You see outlooks, what they expect for the next quarter, what they expect for data center, gaming, and professional visualization, and automotive and robotics, CFO commentary, and all the non-gap measures. But these one are not for you; it's more for the content. So basically, that's the source data that I'm using. I'm also using the source data coming from Investing Pro. I'm paying is a pro subscription level for consensus data. So they use also a lot of the valuation methods that you can see here. Overview. Then you see they use 13 different models, and they have, for each model they have a fair value price today, and they have a consensus average of 169, and the price today is 187. So let's find out if we agree with Investing Pro average consensus price as of today, basing on all the fundamental analysis model that you see here. EV to EBITDA, EV to revenue, this dividend discount model, multi-stage, P multiple, price to book multiple, price to sale multiple, and so on and so on. So let's go into it. And what I'm going to use for PE valuation based and earning per share estimate for the next 5 years, I'm going to use the consensus estimate from the analyst here. You can see for 2026, you have 49 analysts that see a year-over-year growth of 50%, $4.50 earning per share in 2026, $6.35 in 27, 28 you have $7.50. You see the number of analysts is quite good, 49, 51, and 26. And in 29, only 3 analysts forecast for 2029. Consensus estimate is $8.10, and the year-over-year growth is tapering to 8%. And for 2030, you get only 3 analysts with 8.92 and a 10% earning per share growth estimate for 2030. So let's get into this now, and let's look at what the prompt is delivering. So I'm going to show you the size of the prompt, so you have a fair idea about what type of work has been put into designing this prompt. Actually, this prompt is doing what you couldn't do on Excel, but it's doing it automatically for every case, every scenario, and every data that you're going to throw at it. So it's basically making it much faster, much better, and much more detailed than what you can do on Excel, because this model is also interactive. And also what you're going to do, you can also stress test this, sensitivity analysis, and everything you can do to this model. So you can see the size of the model. That is a huge prompt. This one I have developed it over the last 3 weeks. That's why I haven't posted a lot of video. And the only thing you need to do with this is that you put the symbol that you want, the ticker of the company, and the name of the company, and then it delivers everything you're going to see right now. So first of all, it gives you a valuation earning and valuation snapshot. So basically, what you have to remember from this last earnings statement is that the reporting revenue 46.7 billion, of course, 56% year over year. Non-GAAP EPS 1.05, plus 54% year over year. Trailing 12-month free cash flow is 72 billion. 72 billion, be careful, we're going to use that as a base for forecasting the following year's free cash flow. That's also very important to understand that. So the 72 billion trailing cash flow, 12 months cash flow, is the base estimate where you're going to find that. You also have seasonality, consensus forward cash flow, free cash flow of 110 billion. That's a consensus forward free cash flow. But let's see if, according to our model, we're going to reach that also consensus or very close to the consensus forward free cash flow. Gross margin 72.7%. Share outstanding, very important, because you're going to have a lot of metrics to arrive at the share price. Valuation, you need to have the exact number of shares outstanding. And obviously, you have to use the diluted number of shares, not the non-diluted number of shares, if you want to be fair about the valuation of every single share of NVDA into the market. Okay? So Leverage, very low leverage company. I mean, this company is a very, very solid. It actually use any debt. 0.5 times leverage, nothing at all. Consensus numbers. For ADIA 2026 revenue, close to 200 billion, is plus 100% year over year. Earning per share $4.52, plus 40%. And valuation base that we're going to come out with is more or less $185 per share discounted cash flow. And we have a value today of 187. So the model is going to be calculated as a blended between discounted cash flow, price to earning valuation, enterprise value to EBITDA, and the 5 years price consensus is going to be around $350, which is about 15% annualized return. So what is the recommendation? Of course, is going to be to hold, because now NVIDIA is fairly valued according to the model, and you're going to find out that you're going to have a very good 15% annualized return over the next 5 years. So let's skip all the accounting detail that I think is not very important for you, but for the geeks, I'm going to show it very, very, very slowly so you can pause it on your screen and you can go through every single numbers. You're going to see how powerful the prompt that I have developed is. You have a lot of data, quality check, double check, cross checks, and clearance. Everything is done. Okay. Then you arrive to what matters to a lot of people. You have the full analysis of income statement. You have the revenue, cost of revenue, gross profit, R&D, general expenses, administration, operating expense, operating income, interest expense, and you arrive to the net income. Okay, net income quarter over quarter. I mean Q2 425, Q2 426. So year over year 59% increase. That's amazing. Key insights segment: data center plus 53%, 56%. Sorry, gaming plus 49%, and basically you have some adjustment with the H2O chips that you couldn't export to China. So you have a lot of impairment that the company take this quarter because of they were not allowed to export to China. Okay. Full analysis of cash flow statement. That's quite important. That's the latest cash flow statement as per the latest earning. It's the 6 months year over year, not the 3 months year over year, because you want to smooth the data. You don't want to take the too volatile quarterly data, and that's more important for doing this cash flow statement analysis. You can see cash flow from operation 43% year over year, plus Capex increased quite significantly because they are ramping up a lot of Capex for NVIDIA capacity to deliver to the clients, plus 100%. Free cash flow plus 40% from 28 billion to 39 billion. Okay. And you know the free cash flow is your cash flow from operation minus the Capex. You have the guidance, of course, guidance of company 54 billion plus or minus 2%, excluding China, H20 chip delivery. And you have the GAAP gross margin 73.3% plus or minus 50 basis points, non-GAAP margin 73.5%, operating expense 5.9 billion, and so on and so on and so on. You have all the estimate from the management. Management is very, very bullish, says Blackwell demand is extraordinary and the AI race is on. It's just starting. CFO Questlink pipeline strong despite China, so they don't really care about China. China is just the cherry on the cake if they're allowed to export massively to China. What is important is the model is evaluating whether the guidance is reliable or not according to the past, and you have the full table of guidance and forecast and guidance, and what is the percentage beat according to the guidance of the company. And let's go through the table. You can see the model is saying that it's highly credible. They consistently beat the guidance they have given in the past. So it's highly credible guidance they are giving. Okay? And it's very conservative guidance because it's exclude China. So they even say that this is an extremely good quality guidance they are giving. Market reaction, we don't need to go there. We know everyone go through the market reaction after the earnings. Not so excellent price increase. The price slightly decreased, but not the price increase from the earnings, because now we are close to 187. If you look at the earnings date on the 27th of August. Let me see, 27th of August. Actually, just slightly higher. We were 180, slightly higher, 187. You see, we went down quite a lot. After the guidance went down to 160, now back to all-time high. So you see, and if you trust the model that we're going to do right now, and if you trust what the market is forecasting and what the company is telling about the future of the company, then you know the price that you're paying today is a fair price to go into NVIDIA and still make money along the way. You're not going to do 12 times, 10 times, 20 times like in the past, but you are going to do a good amount of return over the next 3 years. So basically, it makes a lot of bullets. Positive Blackwell ramp, beat affirm AI demand. Negative H2O and China, uncertainty weight, so no sales in Q2. Challenges, overblow dip, fundamental strong, rebound plus 5% week after. So basically, fundamental of this company is extremely strong and very, very robust. So the recommendation is to buy any dip you're going to see into NVDA. So let's go now through the valuation method. The most famous one is the DCF, discounted cash flow. So what we're going to do is we're going to start with the cash flow that we have on the last trailing 12 months, which is 72 billion. Okay. And we're going to extrapolate that for the next coming years. Okay. So what we're going to say is free cash flow on time 0 is 72. Free cash flow in year 1, so that means next year is going to be first on a 50% growth. After that, we're going to use 40% growth. After that, we're going to do 30% growth, and after that, we're going to do 25% growth. And then after that, after the next 5 years, we're going to use what you call the perpetual growth rate. It's just a assumption of the perpetual growth rate of the company, and we're going to use 4%. And this 4% is going to be used to extrapolate the terminal value at the year 5 of NVDA. Okay. I'm going to actually skip all the calculation. You all know how to do a DCF. If you don't know, then zoom into the numbers, pause the video, and look at what the model is doing, and you're going to have exactly the price valuation. So basically, fair price per share today of NVDA, according to this very nice assumption of free cash flow growth, and according to the WACC is 10%. It takes the beta of 2.01 of NVDA, risk-free rate of 4%, equity risk premium of 5%, equity cost according to the balance sheet of 14.5%, and there is extremely low level of debt, so we can make the debt is negligible in the weighted average cost of capital, and we know that the growth rate over the long term is 4%, is the level of GDP more or less. So with all that, with a WACC of 10%, a finite G of 4%, an estimated growth of 50, 40, 30, 25% for the next 5 years, and after that a 4% perpetual growth rate, then you get a fair value of $185 per share. So now you can do a sensitivity analysis where you're going to shock the terminal growth rate of between 3%, 4%, and 5%, the base case being 4%. Then you're going to have also a WACC between 9, 10, or 11%, and you're going to have a table of the price where you shock all these different variables. This is very important. Discounted cash flow is very sensitive to assumptions. Okay, that's why sometimes you have huge dispersion of estimate by analysts, because this is not an exact science. Depending on whether you take a WACC of 9%, 10, 11%, you can see even with a base case of 4% terminal growth rate, you go from $160 to $228 just by varying only 1 or 2%. You see, so the most important is to take the average of all of this, and to make different scenario and to blend different valuation method, and then you come up with a more robust price estimate per share. What we can do also is to reverse DCF. We can take the price of 187 today, and we can reverse DCF it to see what is the assumption compounded annual growth rate that the market is taking to give the price of NVIDIA of today. And you can see that if we reverse DCF table, the 187 price of today, you can see that the implied growth rate over the next 5 years is 48%, which is extremely, extremely, extremely optimistic. Okay? We know that historic growth rate over the last 5 years has been 70%, but the last 5 years it has been extraordinary for the NVDA. So the question is, can this 70% can keep going forward? I'm not so sure. But the market is taking the bet that is going to be an average of 48% over the next 5 years. We know the peer medium average, AMD or TSM, is about 40%. Okay? So the base case is 185%. So the base case on DCF is $185 consensus. Okay? If you take the bull case, you actually bump all the data of growth plus 25%. You're going to reach a price of $232 today if you get a bull case. And if you have a bear case, that means you have to take all the estimate 25% down. Then you're going to have an average price of $139. So if you do a weight of the different scenario, base case, bull case, and base case, then you get 35 probability, 30% probability, 35% probability for each different scenario. And what you're going to come up with is a blended of 185 $232 and $139. Okay. So we're going to cross-check these valuation methods, okay? And we're going to see whether or not it's reliable. So let's look at PE estimates, okay? So I forget to give you the numbers. So the consensus is 176 if you blend all the estimate numbers, okay? Bull, bear, and base case. Now if you take the PE, okay, let's take the PE, and let's take the PE based on the okay, let's take the PE based on the market EPS estimate for the next 5 years. And how do I get this market estimate of the next 5 years? I take the market estimates on investingpro.com website. I'm paying a lot to get this data, and you can see that they give EPS over the next 5 years. You can see it's reliable data for the next 3 years, and after that, for the last 3 years, it's going to be only 3 analysts that give you an estimate EPS. But I take this data from the market consensus, okay? That's market consensus, it's not biased data. So let's take different scenario for the PE estimate. Okay, so you can see for the year 26, they estimate 51% growth, 27, 41, 28, 30, 20, and 15. Basically, almost in line with the discounted free cash flow growth estimate that we have used as well. And it goes for 4.5, 6.35, 8.26, 9.91, 11.40. Oh, sorry. I think it's the next table here, where I take the consensus. My mistake. If you use the consensus, sorry, you see 50, 40, 30, 20, and 15, you get this EPS estimate, and then you come up with this valuation according to the bear case 32 multiple, 42 multiple, 52 multiple, you get a fair value in 2030. And what is it implied today? Okay? Whether it's a bear case, bull case, and look at the table yourself, you're going to find out exactly what I mean. All right? So you can say that fair value today, the minimum is 227, which is very, very good, you know, because even on your bear scenario, according to valuation that they're giving and the earning estimate, you get a $227 estimate for NVDA. But now let's take what I told you. Let's take the earning per share estimate of investing.com. 50, 40, 18, 8, and 10%. I just copy and paste exactly what I give, you know, with the number of analysts that actually make the consensus estimate. What I do is I do P average valuation, 42 times earning, bear minus 24% multiple, low growth with a 32% PE, all right, and bull case plus 24% with a 52 times PE, all right. Then we arrive consensus in 2030 of 285, 375, and 464. You see, again, according to your PE multiple, your EPS assumption, you can vary a lot about what you expect as a company valuation. But what is more important for this data, you can see that if you buy NVDA today, even in the bear case scenario, you make quite good money because the price estimate is going to be 285. All right. So that's quite good, you know. So the implied price, according to the PE multiple, is 177, which is very, very close to the price of today. So according to PE valuation, you are very, very close to fair value today for NVDA. So you're not gonna lose money, you're not gonna make money, you're just gonna buy it at fair value. On the base case, it's 233. That means the base case is that NVIDIA now is undervalued. Okay, is undervalued, and you're gonna make at least 25% from fair value. And if you take the bull case scenario, then the fair price today of NVIDIA is 288, and the price in 2030 is going to be close to $500. So you can see NVIDIA is a very, very good investment. Whatever the scenario you take, whatever model you're going to use, and whatever assumption you're going to take, and you can crunch every number I'm showing you on the screen. It's very difficult to argue about this valuation method, you know. So what I'm going to ask now the Grok is to make a table to summarize all the different valuation method and the average price on different type of scenario. Then we're gonna arrive at a final estimate and consensus estimate for NVDA right now and in 5 years. Okay, so you get a nice table here. Okay, different scenario, different valuation method. Valuation method is DCF, PE, EV to EBITDA, blended, okay, and 4 years in 5 years, okay, with a WACC of 9.5%, okay. So bear case, minus 25% growth, China bans, okay. It's the bear case. You assume 25% less growth, and you assume that you're not gonna sell in China, which is very, very reasonable assumption for a bear case, of course. Then DCF, you get a fair valuation of 132, for PE 119, and for EV to EBITDA 138. So the blended valuation on the bear case scenario is $130. And what is the 4 years valuation is $190. Okay? So the base consensus is, according to DCF, 176, close to 180, PE 165, and EV to EBITDA 170. The blended valuation is 170. So very, very close to the valuation of NVDA today. So if you buy NVDA today at 187, you are slightly overpaying. That's it, not more. And your forward price in 5 years is going to be $330. So the bull case scenario, so you mean 25% growth is according to the consensus estimate, and you have a Blackwell ramp, and everything is fantastic, everything else according to plan. So what is the fair value of NVDA today? According to DCF, $220, PE $194, and EV to EBITDA 210. Blended valuation, though, across these three valuation methods is 208. So it's slightly undervalued today if you buy it 187. But what is more important, if you have the bullish scenario, the price of NVIDIA in 5 years is going to be close to $500. So whether you take any different approach, you see that bullish scenario of $500 in 5 years is extremely consistent. Okay? So what is important is if you take a weighted blend, 30, 40, and 30, and the rational binary risk and beta of 1.25, balanced state dynamic for volatility, today the fair value, if you take the weight, 30, 40, 40, and 30% with the bear, base, and bull case, okay, if you weight it down with this different weight of the different valuation method, then you blend it, then you have a fair value today of $170 per share. So you see, it's slightly overvalued, but I would say it's fairly valued because it's not an exact science, you know. If your theoretical model is saying this is worth $170, that's mean if you buy 187, that's okay. It's fairly valued. You're not overpaying. Okay? And the blended evaluation method in 5 years is giving you a target price of $330. So that's mean you're almost going to have a 77% upside in 5 years' time, which is a more or less 12% annualized return. For a big company like NVDA, it's a blended valuation. It's a blended scenario with different probability weighted. And it's going to give you this at least very, very conservative assumption. Nothing extraordinary, nothing aggressive. So I'm telling you, NVIDIA is a very, very good investment. And you have the protection of mega cap story. It has a lot of tailwind. And I think all the surprise is going to be on the upside, not on the downside. That's my intimate conviction. What are the different risks? China bans, competition, AMD, TSMC, AI Capex cut, supply. You know, you have a probability likelihood 35%, 25%, 30%, 40%. Impact high. The impact on share price, you know, minus $25, minus 12, minus 18, minus $8. So you see, you get a full risk impact analysis on the share price according to the different scenario of risk that we are seeing. Catalyst timeline near 1 to 3 months. Q3 earnings now. November Blackwell volume 9 billion. Medium 3 to 12 months. Forward year 26 bit. And Euro AI infra deal. Okay, so that means the European is going to start to build the infrastructure as well as the rest of the world and the US. The long-term catalyst timeline between 12 and 36 months. You have the Rubin GPU launch and all the robotics that is going to bring more or less 10 billion plus. Conclusion: NVDA fairly valued at $170 today. Okay, you have to hold the share if you hold it right now. You have to buy if it goes sub $160. China H200 sales cap near term, but AI dominance is 88% of GPU share market in the world. Imagine 88%. 5 years estimate $330 is about 12% annualized return. 77% upside from 187 of the price of today. So bullish, 1 trillion plus infra, bearish regulation and execution risk. Discounted cash flow fit table, and it fit the stable free cash flow generation of NVDA. So the method that we are using is extremely good method for a company like NVDA. Multiple alternative if cyclical spike, data from official press release. We have also all the assumptions that we have respected. So that's it for NVDA. Hope you have enjoyed this full analysis. I've actually taken the time to go through all the reasoning of this model and this prompt. If you want the prompt in your own AI, just leave me a message below. I'm going to send it to you, or I'm going to copy paste the whole prompt into an external link, and you can actually cut and paste that prompt and do it for yourself. You're going to see it's an extremely powerful prompt, and you're going to save a lot of time and a lot of energy to try to think about all the different scenarios that is possible for every company you're going to analyze on the stock market. I spend my time to do it, and I hope you will enjoy it. Thanks so much for watching. Press the like, subscribe, and see you next